Let's see here. So today we're doing Home Insurance 101. It's going to be kind of a repetitive theme. The third Wednesday of every month, we're going to call that Wave Agency Wednesday, and we're going to go through a different learning aspect of the insurance. Today we're going to kind of dig deep into home insurance, exactly how it works, and then what you guys as real estate agents can do to best protect your clients during the home buying process from an insurance point of view. If you have any questions, throw them in the comments and we can definitely get those answered. But other than that, I will get started. Make myself a little smaller so y'all can see me, or see the material rather. All right. So before we get into home insurance as a whole, I want to kind of do just a quick understanding of how insurance works and some things that are going on right now in the insurance market. Insurance is basically operates on the law of large numbers. Every insurance policy is basically a complicated math equation that the insurance companies have come up with using whatever actuarial data like claims data or data about the consumers themselves, to where they are trying to come up with a mathematical algorithm that will attract clients based on the prices, but then after they pay out what they expect in claims, obviously they'll still be left with a profit. So a lot of times people get offended if an insurance policy goes up, especially if you've been there forever or they file a claim and something happens, and it seems like it's personal or just bad service on the insurance carrier's part. And I get it because I've been in the same boat myself, but ultimately it is just math equations that they are doing in order to try to maintain profitability, and not nearly as personal as a lot of people think. The other thing that you need to understand with insurance carriers is that they typically run an up and down cycle over time. So typically what an insurance carrier will do is if they want to pick up business in a certain area, they will reduce their prices or increase discounts or do other things to make them more attractive, which kind of causes them to dip down a little bit in price, and then they pick up a lot of business. And then eventually they raise those rates back up a little bit over a few years, and they're hoping that a certain percentage of the people that they picked up when they were lower will just stay and not change. And then that's kind of how they grow, and they keep doing that and then going up and down and stair-stepping themselves up to get more business. So that's kind of an overall thing that they're doing, which is why it is so important to be able to go with somebody who has a lot of different carrier options, so that if one of them does that, we can try to find somebody else who's kind of on that downward swing and make a lateral move there. Now, obviously, the whole real estate market and just kind of the world in general has had a lot of stuff going on with inflation and things like that, and how it's infected insurance. So with insurance, they're kind of the last ones to adjust in a lot of cases. Basically, it takes them a little bit of time to realize they paid out more in claims than they expected to, or that construction costs were more than they thought they were going to be, and then they fix that by adjusting the rates on the other side. So sometimes we see the adjustment in terms of rates or changes with insurance a little bit later than the rest of the market sees it, like in the real estate or the construction market. And a lot of times that's just causes rate increases, and that's the way most people see it, but it's not always just rate increases. There's lots of different ways that the insurance carriers deal with situations like that, and sometimes it's just raising the rate, but sometimes we'll do things like coverage increases. Like to give you an example, in Virginia, you're required to quote replacement cost value for a building, so basically how much it would cost if you had to rebuild it. But insurance carriers will have minimums amount of coverage that they require. Like for instance, we had one carrier that required a minimum of $100 a square foot. Now, in a lot of cases, it would be much higher than that based on the rebuild cost of that house, but that was their minimum. Well, to address the inflation and everything, now their minimum is $150 a square foot. So some people aren't necessarily getting a rate increase, they're just carrying more coverage than they were before, which costs them more money. Another one things we'll do, so with insurance carriers, they love to bundle. So scientifically in the insurance business, the more lines of business somebody has with you, the chances of them staying with you for a long period of time go up exponentially. Once you go from one line to two, so like a home and auto, and then you add a third line, the retention rate on that is the highest that you can possibly get. So that is what a lot of insurance carriers will do also, is instead of raising rates, they'll now require, in order for us to write your home, we have to be writing your auto insurance. We've got one carrier right now in particular that's been doing that, and it will only take them if we're doing both. And sometimes that makes sense and sometimes it doesn't. But that's another way that they kind of limit their exposure to increase the profitability during hard times. Other things is they start to get really picky about what type of business they'll accept. For instance, I have one auto insurance carrier right now that if the client had the state minimum liability limits on the previous policy, they won't write them under them. They had to have higher than minimum limits on their prior policy in order to be eligible for coverage. So that's another way that's dealt. And then the most common ones that we see is either non-renewing policies, which we've seen carriers and all across the board where they non-renew certain policies based off of what they call profitability concerns. Sometimes that's tied to what they call reinsurance. So insurance companies have insurance companies themselves. And so if the reinsurance rates go up for the insurance companies, then they're going to pass that along to the consumer in most cases. And then also we have carriers, and this happens a lot in coastal areas like Hampton Roads, where they just say we're not writing any more policies this year in that area, or we're just not writing any policies in that area in general. Generally speaking, in the Hampton Roads area, what happens a lot is an insurance carrier wants a lot of Virginia business. They just don't necessarily want a lot of coastal Virginia business because of the hurricane and wind and hail and all that kind of risk. So they will come in with really great rates in Virginia, but then too many people buy policies near the coast, and so then they kind of cut it off for everybody and things like that. So it's just kind of what we deal with. That's why we work with so many carriers, so we're able to kind of look around and find the options when none other ones exist from the insurance point of view. So that is everything on that stuff. So let's talk about how insurance is paid for, what the coverages mean, and then how we come up with those. So for some of you that might not know this, I myself was a realtor for a really long time. I went through the whole foreclosure the big market that we had in 2000 and then the crash that came after that. I don't practice real estate anymore. I focus completely on the insurance. But I was surprised that for most of my real estate career, I did not know how insurance got paid for when people were buying a house. The lenders I worked with were great. They were doing a good job educating the clients, but I personally didn't understand how it played in. So that's something I always like to go over with the folks in the real estate community. So when you buy a house, now keep in mind, this is most of the case when you have a mortgage. There are some mortgages that will allow the homeowner to pay their insurance outside, but that is going to be by far the exception. And honestly, it's usually just easier if it's escrowed in terms of them making sure it stays current. And a lot of the carriers actually give us better rates if it's mortgage escrowed versus having them pay it on their own. So the first year of home insurance is part of the closing cost. So when the lender is telling them estimate to bring X amount of money to closing, they're including an estimate for the first year of homeowners insurance in there. They're also including a 3-month escrow stock up, basically. So you're going to have an escrow account with your mortgage that is going to be there to pay the future insurance and taxes. So the mortgage company is going to require 3 months of escrow costs to go ahead and go in there, so you have a little bit of a cushion going in. So after that, the first year is now paid for in full. So the mortgage company is going to start collecting 1/12 of the yearly premium out of every mortgage payment, and they're going to hold it into an escrow account. And then next year, when the homeowner's insurance becomes due again, they are going to pay for a whole nother year in full, and then keep collecting 1/12 every month so that they can pay for the renewal after that. And they will continue to do that until you have the mortgage paid off, at which point they can pay the home insurance however they want or decide that they don't want it. Coincidentally, property taxes are collected the same way. I know that in some cities they pay twice a year, but essentially they collect it in the escrow so that they can pay it when it's due as part of the mortgage payment. So that brings me to the next part of this, which is how the insurance cost gets factored in during the pre-approval process. So essentially, it's a guess. So I'm sure everybody knows that a mortgage payment composes of PI/TI, which is principal, interest, taxes, and insurance. So when the lender is pre-approving your buyer to go out and look at houses, they have to make an educated guess at the insurance cost and the taxes because they don't know which home that your client is going to pick and exactly how much the insurance or the taxes are going to be. So if you're working with a strong local lender, they're going to be pretty familiar with the taxes in the different cities, and they're also going to be pretty familiar with what they're used to seeing for insurance and that price range and this. And then the really good ones will also know when it might be a little too close to guess and we need to actually get some insurance quotes on particular houses and things like that. But basically they're doing an educated guess there on what they're used to seeing in that price range in this area. So the things that you want to watch out for is if you're working with a lender who's not your go-to, or it's maybe somebody that you're not really familiar with from out of the area, one thing to watch out for is when they lowball the insurance cost during the pre-approval in order to make the deal appear a little bit more attractive than it is. So for instance, if normally you would estimate $100 to $120 a month for homeowners insurance and they instead estimate 60 or 70, it makes the mortgage payment look like it's going to be a lot lower until we get under contract and realize that the home insurance is going to be more. So that is something that I have seen where less reputable lenders and out-of-town lenders just don't know how to estimate correctly for a coastal region, or they just kind of go on the low side and figure they'll deal with it later and try to get that business kind of under contract and in their pocket. So that is how the thing. So it's basically a really educated guess. And we'll get into why and when you might not want to trust the educated guess and all that. But first I want to show you, so this is a sample homeowners policy. So what I'm going to kind of go through which each of the coverages mean on here, and then kind of how we get that and what's important about that. Number one, let's see here. And I'm just looking at the thing here, and I cut off part of this, but the number one coverage that you're going to have on there is dwelling replacement costs. That is going to be the amount of coverage that is going to be for the building itself. Now, it is often common for that not to be anything close to what they're paying for it or what they have their mortgage on, because we're going based off of replacement cost. So that means the amount needed to replace the building, and we do what's called a replacement cost estimator to help get to that number. From the dwelling cost, you're pretty much going to see that everything else is going to be a percentage of that dwelling cost, or most of the coverages normally are. So, and they kind of go A, B, and C. So dwelling coverage is coverage A, that's the building. And then you're immediately going to have other structures coverage, which covers other structures on the property that aren't permanently attached to the house, like a fence, a storage shed, a deck, an in-ground pool, the driveway, things like that. Most insurance companies will automatically default to 10% of whatever dwelling coverage is. So if you had a $400,000 dwelling coverage and it was 10%, you're going to have a $40,000 other structures coverage. Some carriers will let you reduce that if you don't need that much coverage. But most of them make you stay at the standard 10%, and then for an increased premium, you could raise it if you had a really nice detached structure that you felt that 10% wouldn't cover. After that, you're going to get into the contents coverage, which is the belongings in the house. And typically, most insurance companies will give you kind of a range of options, but a lot of them are going to wind up requiring around 50%, usually as a minimum. So if, let's say, again, using the $400,000, that means that they would give you $200,000 in contents coverage based on that. So that is an important kind of thing to remember in case you feel that you need more coverage than that. And we'll kind of get into other ways to deal with the contents coverage. One important thing, and we'll cover this later, is if you're ever getting a quote for home insurance, you always want to find out if the personal property is at replacement cost. You'll see that where it's checked yes on this particular one. The reason that is important is there's replacement cost and an actual cash value, and they will give you two very different values for your belongings on there. So after contents, you're going to have loss of use coverage. Loss of use coverage is exactly what it sounds like. So if you're not able to use the home because of a covered loss, then that is going to provide you living expenses during that time frame. You know, if you have to live in a hotel or get an apartment temporarily, or even if you're having to eat all your meals out because the kitchen is not usable, but you're still living in the house. Typically, that is going to come at a 20% coverage amount. So $400,000, $80,000 would be the typical that you would see. Most won't let you go below that. Some carriers will offer higher than that, or they will offer 100% loss of use coverage, meaning that whatever the amount is, that they'll pay it. Now, some people really get a lot of comfort from that, but honestly, that's kind of in my opinion, a sales ploy technique on the part of the insurance carrier, because reasonably, let's say if your house burned down and you had to stay somewhere for an entire year, the chances of your living costs exceeding $80,000 are really slim. So it's kind of one of those coverages where they say it's unlimited because they know they're never going to have to really spend all that much, and it makes you want to buy the policy a little bit more. So that one really doesn't help us from there. So those are kind of your A, B, C, and D coverages that are going to be the most important ones on the policy, but there are a few other coverages that we want to talk about that you always want to see as extra listed on the homeowners insurance policy. And that is where we jump over to the second one. So in looking at this, one of the things that you usually want to see is if you're looking about halfway down, you'll see specified additional amounts of insurance for coverage A, 25%. What that means is that the coverage A, let's say if it was 400,000, you're really covered to 125% of that number, and that extra 25% is basically a buffer for if the cost of the claim winds up being more than expected at the time of the loss for some reason. Like for instance, if there's a hurricane and lots of people's houses are damaged at the same time, and the cost of supplies and labor will likely temporarily go up just because of supply and demand. So that buffer is there to make sure there's still going to be enough to fix it. Or like during COVID, I think we saw plywood go astronomically through the roof on price-wise. So if your house would have had a claim during that time, it would have cost more than it was when we estimated the replacement cost of the house originally. The other one you always want to see on a policy is the one right below it, which is water backup and sump pump or sump discharge, commonly just called water backup. You always want to see at least 5,000. Really, depending on the property, you'd like to see 10 or 25,000. That basically is kind of what it sounds like. A lot of times people just assume because water damage, like if a pipe bursts in your wall or something like that, is covered under the home policy. So they would just assume that this isn't something they need and don't know to look for. But water backup would be if the water in your house came back through your drain lines and into the house for some reason. That could be from overflowing the toilet by a kid stopping it up, or the more devastating one is when something happens with the sewage system that causes that sewage water to come back in. It's more common that those type of things happen in situations where the houses are close together, like townhouses and things like that, because it's usually something that one of your neighbors helped contribute to in a little way. But you want to have that coverage to deal with that, because not having it, and pardon my insurance pun, it really stinks when you have a bunch of wastewater coming back into the house and no coverage to do anything with it. On here, and actually when I was going over the other one, some of the limits that I accidentally cut off on my slide are on here. So for instance, the personal property replacement cost. And then here's the other one, liability. The mortgage company is going to require a minimum usually of $100,000 in liability coverage. Liability coverage is what covers you and your legal defense if something happens around the property where somebody's trying to sue you for injuries. So most common is the kid's friend comes over and he breaks his leg in the front yard, and the parents decide they want to sue you because it's all your fault. Not only will it cover the injuries and the damages, but if it's a kind of a dumb lawsuit or not really your fault, then it also covers your legal defense in that. In my opinion, don't ever have $100,000. That's not nearly enough. If anybody's ever had the unfortunate experience of having to go through any serious legal stuff, you understand just how fast you could spend that kind of money. And it's almost no difference in prices, or very minimal difference to increase that to at least 300. Really, you'd like to see 500,000 as kind of a minimum there, just to make sure you have as much coverage as possible. The difference in price is usually so minimal that it doesn't even make sense not to have it. Medical payments coverage is another one you want to see. Usually $5,000 is a pretty good limit. We kind of jokingly call this the "don't sue me" coverage in the insurance industry. Basically, this is a regardless of fault claim that's set to cover smaller medical injuries to avoid them turning into larger liability suits. Like for instance, if your best friend gets hurt at your house and they have a little bill at the emergency room, but they're not trying to sue you and take your kid's college fund or anything like that, medical payments allows that to be quickly taken care of so that we don't have to get into the liability and the whole rigmarole of that situation. So those are kind of the important coverages on a homeowner's insurance policy that you want to look. Depending on the age of the house, you can get into law and ordinance coverages and stuff like that, which basically covers if there was a fire on the house, but now the building codes have changed, meaning you have to update things to bring it into compliance to do the repairs. It provides some coverage for those type of situations. Next, now one big thing to understand is the difference between home insurance and condo insurance. Typically, a homeowner's policy is called an HO3, at least the ones that you're going to see most commonly, a homeowner's policy, and then a condo policy will typically be called an HO6 policy. So a home policy is going to cover the entire building and the property, whereas the condo covers what we call studs in, where basically what it sounds like from the studs in. So the interior drywall, the flooring, the kitchen, all that kind of stuff, as well as the contents, the same as the home, but it's only covering that because there's a master condo policy that covers the exterior and the common areas. So it negates having to carry that. Generally speaking, condo insurance is usually less than homeowners for that reason, but in some cases, not always. Now, one thing you want to watch out for a lot with condos is if you see a condo and the fees are either zero, like a no-fee condo, or they're really, really low, like under $200. You probably want to check and make sure there actually is a master policy, because just because they are a condo doesn't mean there's going to be a master policy. For instance, there's a lot of kind of duplexes that were turned into condos for tax reasons or whatever that have been sold where they're condos, but there's only two in there and there's not really a master policy unless the two owners decide to get one. So you'll see those. But a lot of times I've seen there where they get a condo policy and then they don't have any coverage for the outside of the building or something more serious when it happens. And also another time to really watch out for this would be in the detached condos. If you see a detached condo, it's probably not going to have a master condo policy. Is probably going to require a regular homeowner's policy. So those are the things that we really want to watch out for so that we're budgeting correctly and kind of making sure we have the right coverage in case anything happens after the house is purchased. Now here's another one is homeowners versus landlord policy. This is the one I see probably most common. A homeowner's policy is called an HO3 like we said, but a landlord policy is called a DP3, a dwelling protection. One is designed to cover you if you live in the home as a primary residence or a secondary home, and the other one is intended if you're going to be renting that space out to others so that you have the proper protection. Now, these are completely different insurance policies and completely different insurance contracts. So it is not like you can just change a little thing on your homeowner's policy to make it a landlord policy. You basically have to get an entire new policy and get rid of that one. The exceptions, sometimes condos will remain as, because normally you would call a landlord condo a DP6, like we called it the HO6, but some condo products will have an endorsement where you can just change it to say that there's rental exposure and you don't have to actually rewrite the policy. It just kind of depends on the carrier and the situation. Now, one thing is a lot of you that have clients who are buying a house, but they still own a house and they're planning on renting it out to somebody else and keeping it as investment property, which is an amazing investment opportunity for them. But about 60% of people who do that don't have the right kind of insurance because they don't know they're supposed to update it. They just go get a new home policy for the new one and keep the old home policy riding until either somebody tells them that they've got the wrong type of insurance, and hopefully that doesn't happen when there's some type of a claim situation. So if you have a client who is going to be keeping a house and buying another one and they're keeping it to rent it out, make sure that they update the insurance on that one to have it rewritten to a landlord policy to make sure that they have the right type of coverage in the event that there's a claim. On landlord policies, one of the questions that, if we're doing a quote that we'll always ask, is it a short-term versus a long-term? For the purposes of this, short-term means less than 6 months. So if you are going to be renting it out for terms of less than 6 months, that's a short-term rental. Longer would be a long-term rental. The reason that's important is those will change on how the policy is rated. So if you're buying like an Airbnb type property or going to be doing short-term rentals or things like that, then we want to make sure that the insurance company knows that so that you have the right type of policy to cover you that, because it's a much different risk when you have people coming for vacations or short periods of time than when you have somebody living there in their primary residence for a longer period of time. So remember that if you've got a client who is keeping a home and buying another one, they probably need to update the insurance on the old one. All right, so now I'm going to talk about the two different types of home insurance carriers that there are. You have two. One is called standard or admitted. The other one is called non-standard or surplus lines. They both serve some good purposes, but it's important to know the differences between the two. Most all home insurance policies and auto insurance policies are going to be through standard admitted carriers. And pretty much any carrier that you've ever heard of, Geico, State Farm, Nationwide, Allstate, all that is going to be in the standard. Basically what that means is that in most all cases they provide prorated policy premiums, meaning if you pay for a year of the policy and then cancel it after a month, they're going to give you 11 months worth of premium back. And they're also subject to the state insurance board. So a lot of the same ways that as real estate agents you are subject to the real estate board, which helps make sure everybody is playing fair and doing what they're supposed to be and protecting the consumer as best as possible. We have an insurance board in every state that kind of does the same thing for us, so it gives gives the client basically somebody else that they could go to if they felt like their insurance carrier was treating them wrongly in a certain situation, where they would kind of dig into it for them. Now, they also have what we call non-standard, the surplus lines carriers, and those ones are not subject to the state insurance board. This is basically independent companies that have come up with an insurance product that they want to sell, but they're not putting it through the state insurance board. When you're writing insurance through the state insurance board, everything you do, you have to present to them, then get them to approve it. Like, so if you want to do a rate increase or a rate decrease or change the way that you are rating policies, all that has to be submitted to the state and approved when you're a standard or admitted carrier. Non-standard carriers don't have to do that because it's basically whatever insurance contract they want to create with their clients. So you don't have the state insurance board to go to if you have problems. You would basically just have to deal with them one-on-one, either through lawsuits or lawyers or whatever means that you have necessary there. So that is one of the downsides to that. Non-standard policies are also usually short-rated, which means that most of the time they have once you start the policy, you are automatically going to owe a minimum percentage of whatever the premium would be. Most of them are 25%. So being like if you started a policy for a year and then canceled it after a month, you would still be on the hook for a couple more months of insurance costs because of that short rate percent. It's going to be the most common there. So that's one of the big ones to watch. But sometimes it's the only option. A lot of times if I've got people who are super close to a large body of water, or there's something really specific about the house that's making the standard carriers either not accept it or accept it at a price that is just not something that the homeowner can afford, that's when we will want to look in the non-standard. But that should always be the second option, and the client should always understand very clearly that they are getting a non-standard policy because there's far kind of less guarantees on those than with the standard ones. All right, so earlier I said on the contents coverage, replacement cost versus actual cash value. Super, super important. This is one thing that I see a lot of time when people are shopping around getting insurance prices and just trying to get the number as low as possible, because this is something that an insurance agent can kind of take off a policy and you wouldn't really know that it's something to be concerned about unless you knew to ask. So replacement cost means that it gives you the amount needed to replace the lost or stolen item with a new version of itself. So basically, like if you bought and I always use a flat screen TV for this, and then actual cash value gives you the value of the item as used, what it's actually worth now. So let's say a flat screen TV, you go to Best Buy and you buy yourself a big flat screen TV, it costs you $1,000, and then a week later it's stolen out of the house. So under replacement costs, the insurance company is going to say, well, we need to go buy you another TV as similar as possible to the one that you had, and whatever the cost of that is basically whatever the cost is, and that's how much they'll spend up to whatever your limit is on the policy. Actual cash value would say, well, it's a used TV now, so it's not worth nearly as much because it's not, new. So it might be worth a couple $100. And then that's what you would get based on the actual value. A lot of times we also call it yard sale value. So if you're trying to decide kind of what the difference would be, imagine what you would see things at a yard sale for, and then under actual cash value, that is more than likely what you would expect to get from the insurance carrier. So if you're ever getting an insurance quote, always ask them, are the contents replacement cost or actual cash value? And then if at all available, make sure you get that replacement cost value in there. All right, here's one that comes up quite a bit, where usually during the mortgage transaction, where I'll get a call either from the realtor or the client saying the mortgage company is telling us we have to increase the coverage amount to cover the loan amount. What do we do? So a lot of times I've seen insurance agents that will just go ahead and up that coverage amount to match the loan amount to satisfy the lender, and then think everybody is happy, but really that is kind of doing a disservice. So in the state of Virginia, there is a requirement that a lender cannot require you to over-insure your home on the homeowner's insurance to satisfy a mortgage requirement. And what we have to do in that case is basically explain why we're insuring the house for the amount that we do. When you buy a house, you're buying it based off market value, which is based off comparables and what the other houses have sold for and the condition and things like that. But from an insurance point of view, we don't care about the land value. All we care about is how much it would cost if we had to rebuild it. So that's the estimate that we do. Sometimes it's right around what they're paying for the house. Sometimes it's a lot less. So for instance, if you were buying a smaller home in a really expensive area, then the land and the location makes the property worth more, but it doesn't make it cost any more for us to rebuild the house. So we'd be insuring it based on the lower amount. The converse of that is if you have a situation where the house is a really good price, but the amount needed to replace it would be much more than that, then we're actually insuring it for more than the loan amount in that case. But all of those we determine by doing a replacement cost estimator. So if the mortgage company ever asks your client to increase the coverage because it's not enough for the loan amount, basically we just need to provide them with the replacement cost estimator showing them how we arrived at that number, and that will satisfy that requirement because increasing that coverage does not do you any good. It basically provides coverage that you're paying for but that you're never able to use because the insurance company, the way it works, so they're going to figure out how much it costs to replace your house at the time of the loss, and then that's how much they're going to give you up to whatever your coverage limit is. So if you have your house insured for $500,000 but it only costs $400,000 to rebuild it, the insurance company is not going to give you $100,000 extra because you were paying for that coverage and the house was completely destroyed. They're going to give you $400,000 to rebuild it back the way it was. So paying for that extra coverage doesn't do you any good whatsoever as long as we're comfortable that the coverage amount that we have is going to be enough. So in those cases, just reach out, ask the insurance agent for a replacement cost estimate or ask them to provide that to the mortgage company, and that should be good. On a side note, whenever we're sending out home insurance paperwork to lenders for closings, we just automatically include the replacement cost estimate when we send it to them. That way it saves them the trouble of having to come back and ask for it. And most of the good local lenders in our area are familiar with this, and they're loan officer assistants and processors and already know to ask for it, but we try to give it to them ahead of time to kind of cut that out. But that is one of the common things that I hear a lot during the home purchasing or refinancing process. All right, now here's the ones that are kind of the most important takeaways for this, and this is how we can protect your clients during the home buying process and kind of what pitfalls to look out for. One of the things, back when I was a real estate agent, I had a manager, and one of their favorite quotes was always be the source of the source, but never the source. And for real estate agents, that's true. And I think you guys get a right a lot when it comes to like legal questions, saying, hey, that's a lawyer question, that's a lender question. You probably want to be the same way with insurance. Being that you're not a licensed insurance agent, you don't want to make a statement that winds up to not be true, and then they're holding it against you because you made that statement without having all the proper knowledge there. So in all cases, when it comes to that, try to have an expert or a source to refer to and not necessarily be the source yourself. Some of the most common ones, like I said earlier, out-of-area lenders. So if I'm writing a home insurance policy in Richmond or further into the state, the rates are usually going to be a lot less than they're going to be if I'm writing it in Virginia Beach, because most of it is the coastal. So if you have somebody who's using a lender who's not familiar with this area, they might be estimating the insurance based off of what they're used to seeing in their area. Happens a lot when somebody's got a family friend who's a lender just in another area. That's when I see it most common. And you'll also see that with lenders who are trying to attract business in less than correct ways, where they, like I said, they might lowball the insurance cost during the pre-approval to help lock in the buyer, and then just trying to deal with the fallout when the insurance winds up being more later. So that is always good. You can ask the lender, what are you estimating for insurance? And then, we're always happy to answer and say, that seems like it would be reasonable, or that might be a little ambitious, and kind of know when to watch out for that. The other thing we want to watch out for is if you have somebody with a tight debt to income ratio. So I'm sure all of you know that mortgage companies, when they're pre-approving you, after they decide whether or not you qualify for a mortgage at all, then it becomes a matter of how much can you spend in your monthly payment compared to how much debt you have. So if you've got a client and the lender is saying that they are right at their pre-approval, they're trying to spend every dollar of it, and if one thing goes wrong, this deal is going to blow up. When you get into those type of situations, remember that the insurance that was used during the pre-approval was a guess. So it might be a good idea before you write a contract to go ahead and get a full insurance quote so we know exactly how much the homeowner's insurance is going to cost to make sure that they're still going to qualify for it. I mean, if it costs more, they would still figure it out later. The loan would probably be denied and everything would be over with, but then you've paid for home inspections and possibly appraisals before you get to that point where you're not going to get that back, not to mention you've just wasted a bunch of time. So that, not to mention, in the consumer disclosure and in the contract, both of those spots give the buyer an opportunity, to say, hey, if you want to look into home insurance, you're supposed to do that before you write this offer. Don't use that as a reason to try to get out later. Now, obviously, if the loan denies, that's the reason, but it's something that we can avoid ahead of time. So in those tight debt to income ratios, you definitely want to look out for that. Here's another one: large older homes in lower priced areas. So I'm going to use the South Norfolk area as this for one that is the most common where I see this. So a home that is close to or over 100 years old, the rebuild costs on those are always going to be a good bit higher, just because of the building codes then versus now and the materials used. And in some cases, insurance carriers won't take them at all if they're over a certain year old. So what you might see, like for instance, in certain areas, you might have a house that's 2,500, 3,000 square feet, but it's selling for 250,000. So when your lender pre-approved them at a $2 or 250,000, they were expecting an insurance price that went with a $2 or $250,000 house. But if the rebuild cost winds up being, and I've seen this in some cases, 450, 500,000 because of the size and age of the house, then that's how much the insurance is going to be based off, which is going to drive the cost up higher than expected. Another thing with that is historic homes. If the home is historically registered, it is almost assuredly going to be a nightmare on the insurance. Insurance carriers do not want to insure historically registered homes because they are subject to the historical society, or if you've ever dealt with one, I like to call them hysterical societies, because they micromanage everything that you can do. So in a claim situation, the insurance company just doesn't want to have to sit there and deal with a board of people for every repair that they're trying to make to the house. So they just rather not insure them at all because it can get costly and take up a lot of time. So if you're seeing homes like that, that is almost assuredly going to be some insurance challenges that you probably want to figure out ahead of time. Pools. So a lot of people ask, does having a pool make the insurance more? Having a pool in and of itself usually does not affect the insurance as long as there's a fence around it, or it's not like other people don't have access. It's only when you have diving boards and slides that it starts to get a little bit extra tricky, and not necessarily that it'll make the insurance carrier insurance cost more, but let's say I'm shopping with 20 or 30 different home insurance carriers. I would say probably 55 to 60% of them will not insure a house with a diving board or a slide. So it's not necessarily that the insurance will be more, but there's a chance that one of those carriers that won't take it could have been my best price option. And so from that thing, the price could be higher. Another one that is homes far away from fire hydrants and fire stations. So if you've got a house that's way out in the country, there's no fire stations and fire hydrants, that's what we call a higher protection class, meaning if something happens, it's going to take longer for somebody to get there and put the fire out or do whatever to minimize the damage and minimize the cost to the insurance company to fix that damage. So if you've got somebody going way out in the country, might be a time to get an insurance quote ahead of time, because we want to make sure that that cost is going to be in line with what we're estimating for, to make sure that the mortgage is not going to have any issues. In the same kind of vein as that is homes with lots of acreage. Most insurance carriers don't want more than 2 to 3, maybe 5 acres max. Some insurance carriers will take more, but if they have more than that, a lot of insurance carriers just won't take it. So it doesn't, again, not that it will be more, we're just eliminating a bunch of shopping opportunities right out of the gate, which could have been our best option. This is also going to go the same if you're doing homes with acreage. If we're talking about having farm animals, horses, things like that. Some will take certain types of farm animals, some will only take it depending on how many you have. But if you start to get into things where there's like commercial farming, that's going to be renting a field out to a farmer who's going to plant stuff there, or different things like that, boarding animals, that's when it's going to start to get really tricky on the insurance, and we probably want to have some talks real early in the process to make sure that we have something good. Homes with older roofs, typically one of the best things on insurance is when they tell me we just replaced the roof, because usually that gets us a discount. But roofs within the last 10 years or so are usually going to be okay, but some carriers will start to drastically penalize the policy for roofs older than that in different situations, or just flat out not accept the roofs at all. In that same vein, a lot of times patched roofs become an issue with insurance carriers, even though the insurance carriers are often the ones that pay to have the roofs patched in the first place. But from a new insurance carrier taking it over, a lot of times that is something that they'll have a problem with. Whenever you do a new home insurance policy, the home insurance carrier has the option to do a visual inspection, usually just of the outside. Most of the time people never know that they were even there. They just come by, snap some pictures, send it in, and everything's good. Now, if they go out and to do that and they see that there's a patched roof, then you might wind up with an underwriting notice saying, hey, replace the roof or get new insurance. And sometimes we can work with that, but if you're seeing older and patched roofs or roofs that are in bad shape, that could cause a problem once they do the inspection. And the same thing if you're seeing homes where there are branches that are just hanging right over the roof kind of precariously, that's another thing that the home inspectors, or not the home inspectors, but the insurance inspectors like to hit. Now, one of the ones that I get a lot, I get called from home inspections probably once a week on this one, is polybutylene or Quest pipes. And a lot of times the home inspector or whoever will tell them, hey, you're not going to be able to get insurance. It's going to be really expensive. In the same way, kind of with the diving boards and the slides, it's not necessarily going to be expensive because most insurance carriers aren't surcharging for you to have that. It's just most insurance carriers won't cover you at all if you have that. So again, that probably eliminates 75+% of the insurance carriers that we work with, so we're just looking at a lot less options in order for us to find something that works best for you. So one of those could have been the best. So if you find out that the house has poly or Quest piping, we want to get insurance quotes immediately, especially if it's during the home inspection period when you're kind of still in your get out of jail free phase. That way we can find out how much the insurance is going to cost if you decide to move forward with the poly pipes, to make sure that's not going to be prohibitive or something that you don't want to deal with. One of my least favorite ones to address, because just kind of on a personal level, I don't love it that much, is aggressive dog breeds. A lot of insurance carriers will not insure you if you have certain breeds of dogs. Pit Bull is going to be the number one, or Staffordshire Terrier. They have all figured out that was both mean the same thing, so that doesn't do us any good. But generally Rottweilers, German Shepherds, and some of those larger chows and things like that are going to be the aggressive dog breeds that the insurance companies restrict. Now, I have had dogs that are on those lists, and I don't like the rule, but I understand the math behind it. Essentially what they do in coming up with those lists, or when they're going to do that, is they take all the claims that are paid out based on dog bites and the dollar amounts, and then they see which breeds are responsible for the most payments. And then that's how they make the decision. Now, I know that's not fair, because I know lots of people with the sweetest pit bulls that you have ever seen that would never hurt anybody, and I have seen some Chihuahuas that would take your absolute head off if you can. The difference is a Chihuahua is not going to cause $100,000 in damage, and the insurance companies don't care that your dog is the nicest one ever, because they don't know your dog and they don't believe you. So definitely something, if you have that, a breed that's likely to be on that risk, it doesn't mean that it's going to be more. Again, we're just eliminating a lot of our carriers. Some of our carriers will allow dogs that are on the aggressive dog list if they have, I think it's called the Good Neighbor certification, basically, where a certain level of training and things like that. But generally speaking, we just want to find the carrier that's not going to restrict against that. And then outside of aggressive dog breeds, some of them, one of the questions we get a lot is if the dog has ever bitten somebody. If you have a dog that's ever bitten somebody and it's been required a claim, the insurance is going to get really tricky at that point, because nobody wants to take the chance on that being the other one. The other one, and this isn't necessarily something for during the process, but just more a way to advise your clients to make sure they're protected. Most all insurance carriers have a rule about if the house is going to be vacant for a certain period of time, of letting them know, or it could possibly void the coverage. Usually that time frame is 6 weeks. So if the house is going to be vacant, I would say for longer than a month, and this happens a lot of time at move-in, where they don't move in right away. In addition to that home policy, we might want to write them a short-term vacant dwelling policy, which would cover anything that happened while the house was vacant during that time. The same vein, if they are doing some renovations on the home, whether they're going to be living there or not, depending on if it's more than just simple cosmetics, those renovations are not really covered during the home insurance policy or process. So getting a builder's risk for a short-term period of time is usually a good idea in those, to make sure they have the proper coverage if anything should happen during the renovation period. Those are the main things to look out for on the insurance, kind of when to clue us in, so that we can jump in and help out and provide some quotes. But we're always happy to provide home insurance quotes for anybody. Some people just like to have all their numbers in a row before they write that offer, and we can usually do that pretty quickly, so that they can know exactly what the mortgage payment would be going forward. If you're getting into I know we haven't had it as much lately as we did before, but I've seen a few bidding wars lately. A lot of times that's a good time to get us involved, because if bidding wars, we're trying to see how high we can get and to get the house, we want to know how far we can push that pre-approval in order to do it. So at that point, factoring in the taxes and the insurance costs, we can figure out exactly how much they can offer to be as competitive as possible, and try to jump in and get that house. So That is pretty much, I think, everything I had. That sure is. On Home Insurance 101, I think next time we're going to kind of dive into, I was thinking about condo and what some of the effects and changes of that are. But if you have any questions, definitely message me. I'll have a recording of this up later for anybody that didn't get to see it. Any teams or brokers out there, we would always be happy to come in and do a presentation for your office one-on-one. I'm more than happy to help out and kind of do that. We'll even bring some food with us, so that will be a good time. But if we can help anybody out with anything insurance related, you know where we are at, and jump on the wave. All right, y'all have a good one.